Well, thank you, LSI, and thank you, everyone, for joining us here. We do have a great panel for this afternoon, and as we said, we're going to look at M&A. In the rearview mirror, we're going to look through the windshield and what we think is going to come, and get some perspective of just some of the macro themes that are going on across medtech. But first, I'll allow the panel to introduce themselves. And Jennifer, you want to start?
Yeah, hi, I'm Jennifer Freed. I'm the co-founder and CEO of a company called Flow Medical. We're developing a next generation PE thrombolysis catheter. This is my second company. My last company, Explorer Surgical, is an LSI alum, and we exited the business in 2021.
Hi, everybody. Greg Banker. I'm with Vensana Capital. We're a medtech-focused VC firm, currently investing out of our second fund, which is a $325 million vehicle. We invest across the whole spectrum of the life cycle, from product development through commercialization. Currently a team of 7, headquartered in Minneapolis, but spread between California and DC as well.
Great. Bennett?
Bennett Blau, Managing Director with Goldman Sachs. I help lead our medtech franchise, sit in Los Angeles, work with companies both large and emerging. Very excited to see how popular this event is every year. Obviously, lots of innovation coming, not only to California, but globally. So good to see everybody.
Great. And with that, we thought it would make sense, since we are a data-driven organization, to take a look at some of the numbers. And so, as we came out of 2023 and into 2024, was I think really just enlightening to see what was going on in the medtech sector, and to do that both from a revenue perspective and from a profit perspective. And so as you look at some of the forecasts, as people set new guidance for 2024, revenues continue to be forecasted to increase. So roughly up from 5% to 6%, but still headed in the right direction. But probably more importantly, actually profits are forecasted to increase pretty significantly. And while they're flat over the last year, they're actually forecasted to increase by about 8% in 2024. So I think one of the more important questions that we're asking is, what is MedTech going to do with all that excess cash and that stockpile, and where will it be allocated? So it's one of the themes that we'll kind of try to unpack within the panel here today. One of the areas where we expect to see continued spending is internally, when that's with respect to R&D. And so we saw that actually increase last year a little bit over 8% across the industry. So a lot of capital being allocated there. Interestingly enough, capital raising was down. We'll get some perspective both from Greg on the VC side, from Jennifer on the emerging company side, what that environment really looks like. But more importantly, M&A, and you can look at the bottom chevron for this, industry-wide, typically averaging 50 to 55 deals per year. Over the last 2 years, only averaging about 35-ish deals. So volume has been down over the last 2 years. Interestingly enough, we saw a run up in valuations over that time as well. And so one of the themes in past years that we've talked about was this theme of valuations. Were they too high, and how do you really make the math work from a valuation perspective? So what we'll do is, those return to normal-ish levels. And then interestingly enough, private equity numbers were down last year again, but we're seeing some robust activity there, including a deal today that we'll talk more about. And then corporate carve-outs still representing roughly 20% of overall M&A volume. And so we'll talk a little bit about that and how things go in the portfolio. But before we get started, I'll have Chris just do a brief introduction, although you need no introduction since you've been on 4 panels, and like an NFL player at halftime, you probably need an IV drip here. But just a brief introduction, Chris, if you will.
Sure, yeah. First of all, is this on? Can you hear me? All right. First of all, thank you for having me. Yes, this is the, third panel of my 4 today. So they have me packed with a bunch of different panels. So Chrissy, I lead corporate development and M&A and venture investment for Medtronic. I've only been in this role for now 4 weeks. Prior, I spent most of my time on the cardiovascular side at Medtronic. I've been with Medtronic going on 14 years, all in a business development M&A capacity. So just a little bit of background on me.
Great. Thanks, Chris. And so as we dig in, I think everyone was kind of excited when, to kick off 24, we were out at JP Morgan, the Axonics Boston Scientific deal gets announced, a few other transactions along the way, but thus far it really hasn't kind of kicked in. And, Bennett, since you have the perspective of, really sitting over a lot of M&A activity at Goldman, what are the large OEMs, kind of telling you? Is it, that there aren't enough targets to, actively go at it? Because I'm hearing that everybody's busy, but it's also that, it's taking a lot to get deals done. And we're going to come back to your deal announced today because that's going to fit in another subject. But just from an overall perspective, how are you hearing it from the corporate side?
Yeah, thanks a lot, John. Thanks for moderating this. So I guess I'd say a couple things. At least when we sit back and hear what large cap medtech is really talking about, if you were to look back, 2-3 years ago, obviously 100% of the focus was on moving the needle from a growth perspective, meaning how do we think about acquisitions that not only make a ton of sense in terms of enhancing the strategic portfolio, fit with the platform, move into new adjacencies, but how do you move the needle from growth, especially for companies that trade from a public market perspective largely on growth expectations. I think if you fast forward to today, the interesting thing is if you look across where the public markets are and you look at the things that really drive, at least from a financial perspective, banker's perspective, valuation, growth is still the strongest predictor of differences in valuation, public market valuations for large cap medtech. So that relationship has not changed. But I do think that the sensitivity to dilution, the sensitivity to de-risking from a clinical perspective, also to some degree from a commercial perspective, although I think there's probably less sensitivity across the board than clinical de-risking. Sensitivity to dilution is probably much more heightened than that has been, certainly 2 years ago. The amount of capital that is available, I think, remains exceptionally high. This is both from a corporate perspective as well as from a financial sponsor, financial party perspective. But I think the criteria has increased substantially in terms of the de-risking I was talking about, in terms of checking the box not only on growth, but quality growth, recurring revenue, good business models. And so I'd say, certainly from an M&A perspective, John, when you think about the large cap folks, many of the same themes continue, but I'd say the bar has become certainly much higher over the course of the last 18 months.
Yeah. And I guess, Chris, I think we've heard in a couple of different venues that that's a similar situation at Medtronic. But what will it take for any inertia to really, make its way into the system? Because I think one of the things that, what's anything that could move the needle to kind of accelerate, the M&A, activity?
Yeah, I think if you got to look at history for a second, right, for Medtronic. If you look at kind of 2021, 2022, really active years for us. If you just take cardiovascular, we spent over $3 billion in deployed capital into that space for acquisitions, many of which you probably didn't even see a headline because we don't announce a lot of them. But some of them we did, Affera, CathWorks, some of the other ones, right? And so we actually were really active in 2021, 2022. 2023, right, to Bennett's comment, right, it was really about how do we focus internally and improve our earnings power? How do we get our margins back to where we were pre-pandemic, right? So some of those types of topics were, top of mind for us in 2023. So when you look at going into 2024, right, I think we're coming off a low base in terms of activity for us in 2023, but I still think that, there's some headwinds from a macro perspective that we're looking at and evaluating. inflation, interest rates, all those types of things, a low stock price for us, right? And so how do we actually look to change that? And part of that calculation is, can we go out and get some near-term growth? Well, there's not a lot of near-term growth that is out there that we could go buy that is at a reasonable valuation. And so it's constantly looking at that near-term growth versus that dilution that Bennett talked about, and evaluating how can we actually get that. I think we got to work through some of the macro stuff that's going to play out, I think, in the next 6 months. But I also think that we're still looking and active. We just haven't pulled the trigger on a lot of things.
Yeah, no, it's an interesting time and an interesting situation. And I think in some of the corporate venture capital panels yesterday, we heard maybe two ends of the spectrum too. So it's different. It's interesting how it's different across the medtech space. But with that, I guess, Greg, from a venture capital seat, how are you advising your portfolio companies, and how are you encouraging them to set strategy with these types of dynamics?
Yeah, thanks, John. I appreciate you organizing and having us on the panel today. So, for us, I think you guys have probably heard this theme the last few years. It's no longer kind of, especially for commercial stage companies, growth at all costs. I mean, you really have to have a believable story to, what a cash flow break-even plan would look like. And so I'd say, in the boardroom and otherwise, you're constantly having this discussion on, how do we extend runway? What's a leaner plan look like? And, as is often the case, you say, well, let's see two plans, the more aggressive one and the leaner one. And everybody looks at that and they say, well, we don't like the leaner one as much. And then you try and find something in the middle. And, it's a balance, right? Because at the one end of the spectrum, your job is to eliminate risk and knock down milestones. It takes capital to do that. On the other hand, companies are often valued on revenue, right? And so you want to drive growth as well. And so it's very company specific, and I think there's no one size fits all, but I think we can expect the theme of, hey, let's make our capital extend further and be more efficient and leaner is probably a theme that's here to stay.
Yeah, no, it seems like that. But Jennifer, if we put you on the witness stand, we say make the case for taking dilution now to in lieu of that higher revenue growth in the future as a startup. I mean, how do you make the case to someone like Chris, or even Greg might be a venture capital sitting on your board?
Yeah, I mean, it's all stage dependent, right? And so, when you think about medtech, it's just like any other industry, and it's cyclical. So, I'd be lying if I said I wasn't happy that I sold a company in 2021, which is a very good time to sell a company. It's a different market today. But I think, you have to be thinking about what are, those subcategories within the industry where you're going to see a lot of growth, right? So in pulmonary embolism, this is a space where we see PE intervention procedures growing 20 or 30% year over year, right? So we're in a category that is very fast growing. But I think for every company, they're thinking about their own portfolio. Are they prioritizing revenue growth? Are they focused more on profitability? And when I was looking for a new business to be in, I wanted to be in a category that was going to be appealing on both of those levels.
Yeah, no, it makes sense and fits with the strategy for sure. But I think one of the things we've seen in medtech, and it's a common theme here, get to 2023, things like inflation and FX really crept into the profitability. The street was all questioning, large OEMs, when are they going to get back and kind of return to that profitability? That actually forced, a critical view on the portfolio at a certain level. And, we're still seeing, a lot of, spin-outs, carve-outs, divestitures. Bennett, why don't you maybe lead us off here, because you can talk about the deal of the day. And some of the things that we're seeing, just some of the insight that's leading companies to, that it's not only just, process improvement and profitability improvement, but sometimes you have to take a bigger, stance on the portfolio.
Yeah, no, I appreciate that, John. So I think the transaction you're referring to is Johnson Matthey's, their sale of really their CMO business announced this morning to a private equity firm. Look, I think that really underscores a couple of different themes that are at the forefront of what we're seeing within the broader medtech market. I'd say the first is kind of a rationalization, pruning, refining, however you want to talk about it, from a kind of large or even mid-cap corporate perspective, which is how do we think about optimizing our portfolio in such a way that's going to be aligned with our strategic goals? How do we make sure that we're continually evaluating that? That's not just a one-time, snapshot in time, but doing that kind of year in, year out. So I think that's one element. I think the second element of that transaction is, one of the big themes we've seen is just the intensity of focus, intensity of activity in the CMO market, which is really the medtech manufacturing market. This is an area which, frankly, over the course of the last decade probably has not gotten as much attention. Certainly within pharma, it has actually gotten more attention. I think folks probably saw the Novo Holdings Catalent acquisition, which was obviously kind of big in the pharma world. But I think the focus on supply chain from a medtech perspective has certainly been a theme that has garnered a lot of interest. And when you think about kind of areas where medtech and pharma from a thematic perspective are somewhat converging, I think this is one example of that. I think there are other areas, whether you look at clinical trials or otherwise, where you have other convergence from a pharma and medtech perspective. So I think, John, today's deal is kind of a emblematic of a lot of what we're seeing in the medtech market, but certainly as it relates to that corporate rationalization.
Yeah, and certainly I think the 3M Solventum,
Of course.
which is coming in a few weeks, and then the Edwards deal. We'll talk a little bit more about those and the implications for maybe broader M&A in a little bit. But Chris, I know you guys obviously the ACM business. You made an announcement there, not to proceed with a divestiture, but you were also, or at least management was quick to point out, hey, this doesn't mean that we're going to necessarily take other divestitures, really off the table. That we're going to continue to look at the portfolio. So maybe just tell us what you can about the evaluation of the ACM process, and then also where that leads you guys prospectively.
Yeah, thanks. So when we set forth to do that spin out of our patient monitoring and respiratory intervention business, right? Obviously, it was a different time. It was it was 18, 20, 24 months ago. And the environment was much different at that point, right? And as we looked at it, going through the process, as you go through these portfolio decisions, you end up doing your own diligence on your own self, right? And you learn things, and you find things that you like, and you find things that you don't like, right? And so as we were going through that, and the environment was changing in terms of the market potential, we kind of reassessed and said, look, let's take a look at this again in a much granular and deeper assessment, and should we keep this in light of kind of the market situation? And so we ultimately made the decision to keep it, and part of that, right, was to also shut down part of the non-profitable piece of the business, in order to deliver the earnings power that we need as an organization across our enterprise. And so obviously it's not an easy decision, right? Because we went out and was doing all the work, had put all the teams in place, to all the separation work, did all the the soliciting of bids and deal, and then ultimately, based on what we got back, said, is this going to add the most value to our shareholders? And ultimately we said, no, actually keeping it is going to add the most value to our shareholders. And so, we are going to continuously look at our portfolio. We feel good about our portfolio and what we have in it, but there's always going to be continuously evaluating the different pieces of our full suite of businesses to say, are they adding value in that given point, or do we think that there's a better solution to add value to our shareholders? And I can't sit here and say that there's never going to be any separation, and I can't say that there's going to be all separations, right? Yeah. So it is a constantly evolving and an assessment that we are doing, similar to like what Bennett just said, that he thinks it's going to be an annual. I think we're going to be constantly evaluating separations.
Yeah, no, it's always continuous improvement, right? And sometimes things do change. So yeah, go ahead.
I think the other piece of it, right, that I would say took away from it is there's also pieces in our portfolio that we could just look at that are not profitable today.
Yeah.
different product
that's right.
lines, and that we can, I'll use your word, prune or rationalize, and it actually will have a positive impact on our return for our investors.
Yeah.
So there's things like that we're going to also be doing in parallel.
So accomplishing kind of a tangential benefit that you were ultimately looking for as part of that transaction, for sure. So 20% of those deals that we talked about were the carve-outs. 26% are private equity. There's almost, I think, 1.2 trillion of dry powder that's in the system, and globally, private equity. And, we're seeing, firms like, Blackstone, KKR, like move into earlier stage. How should some of the investors, Greg, kind of think about private equity and where it's at? I mean, it seems like in medtech, at least, that we've seen an uptick in 2024 with a lot of money going into fields like, cardiac ablation and some of the robotics companies continue to get funding. But, where are we from just an overall private equity and kind of VC standpoint?
Yeah, no, it's a really good observation, John. It's it's great to see just another kind of investor type, I think, enter our sector and put capital to work. The funds are different. They're different strategies, different structures than a traditional venture firm. So they're often looking to put much more capital to work, on the orders of hundreds of millions of dollars, often looking to take a controlling ownership and more often than not pursuing kind of later stage assets. And so, some of the deals that we're seeing, Blackstone and others do are, just deals that probably a traditional venture firm is not going to be able to touch, just one, due to, capital requirements, and two, just due to timelines, et cetera. But I think where we see some, optimism is, some of those companies with, the right funding and the right teams and the right strategies, could become bona fide acquirers down the road.
Yeah.
Hopefully of the companies that we're fueling more on the earlier stage side.
Yeah. And I mean, Jennifer, as an early stage investor, are you, seeing some of these funds kind of come into even your space and fund transactions?
Yeah, I mean, I think it's we're still in the early end, right? Series
Yeah.
A, but I
Yeah.
think you are seeing more and more interest in going earlier, and you're seeing some
Yeah.
of these new vehicles emerge. So if you look at Ajax as an example, I mean, that's you see KKR and H&F, putting
Yeah.
real capital to work in early stage med tech, and I think that's really exciting and really
Yeah.
welcome in this industry. So I think as an early stage company, it's exciting to see these different types of capital coming into play, and there's all types of opportunities that you can pursue.
Yeah, it certainly adds to the excitement because there used to be just the early stage and then, some crossover funds that were really, tourist venture capital, I think often referred to. And then the big PEs, which were always looking for leverage buyouts. And so they've gotten a lot more diversified in their approaches. And I guess, Chris, maybe back to you, because when you guys had a Blackstone deal, that was a couple of years ago, there are these, the Ajax type deals. I think one of your colleagues may have said, hopefully there are no accountants in the room. We're going to be creative on looking at our balance sheet. But, how are you guys thinking about leveraging, just alliances with private equity at this point?
Yeah, I think obviously you've seen us do a handful of deals with Blackstone. The way we kind of look at it, right, is we have organic investment and we have inorganic investment, and how can we increase the capital across both of those, right? So how can we do more M&A? How can we do more minority investments to incubate and develop technologies and companies? How can we actually fund more of our internal programs that we would love to do, but we can't do on our P&L? And so looking at these creative structures like a Blackstone, like other ones that we've done, structured deals, it's all for driving more innovation and dollars towards innovation to actually get to those growth numbers that we would hope to get to in the future. Blackstone is a great partner of ours and really helps fund a lot of our programs. We have, well over $1 billion of investment coming from Blackstone into our P&L, and funding programs that are material for us. And so it's critically important for us to look at those.
Yeah, no, it's a critical source of capital, and funds the ecosystem, as we say.
Yeah, and I think that's the key, right? It is an ecosystem, and it has to work along that full ecosystem. And when there's a cog in that ecosystem, then things don't flow.
Yeah.
And so if venture isn't putting money in, then somebody needs to fill in for that, right? And so that's
Yeah.
why 10 years ago we started doing a lot of structured deals, so that we can then be the one that is doing the tranche financing and then have rights on the back. It's all the same. Now we need some more later stage dollars like Blackstone to take the clinical and reimbursement risk, so that we're taking the commercial risk, right? And that's what we're good at, is taking a technology and driving it to standard of care and getting it to the mass amount of patients that need this therapy.
Yeah.
But everybody has their piece that they do really well, and that we as an ecosystem have to work together across the board.
No, I mean, and look, that was one of the levers that didn't exist like 5 years ago, right? I remember some early meetings with some of your executives to kind of explain what was going on in pharma and really bring that thinking, to kind of medtech. So really interesting evolution. Bennett, maybe to round out the private equity, because I know you have some perspective, I think, on the Zeus EQT deal. We saw an interesting take private, with NanoString and Patient Square. We saw a carve out with, HIG and Zimviv. So, where do we think kind of that, deal making perspective? Are we going to see more carve outs, more take privates, and more, secondary trades?
Yeah, it's a great question. Look, I think a lot of the commentary, even that Chris was making, I think is very much a reflection of a private equity industry that has become much more sophisticated over the course of the last, even 5-7 years. And it's not just that the pools of capital are orders of magnitude greater than they were 5-10 years ago. It's also the level of creative thinking in different situations is certainly at an all-time high, and the level of effort that goes into getting the right external advisors, whether it's from a tax perspective, accounting perspective, the lawyers, to really find transactions in those complex situations, that has gone kind of way up. And I think the deals that you're describing, John, are very much a reflection of that. And so, you just gave an example, you kind of ranging from very distressed, very difficult situations to best in class, highly competitive contract manufacturing situations. If you think about the full spectrum, I think it just means that private equity is able to step into being a solutions provider in ways that they haven't historically. And I actually think, Chris, the fact that, when you think about when Medtronic started moving down this pathway from a structured perspective, that was way ahead of its time. Because if you actually still talk to investors as well as companies at this conference, I think one of the most misunderstood elements is some of the new pools of capital and some of the new vehicles that are now available in the market to help drive different objectives, both for earlier stage companies as well as large cap, later stage companies. So I think, the deal type variation, John, that you're describing, I think is just a reflection of the sophistication of this capital base.
Yeah, it's going to be exciting to watch, and I think it'll be an active part of the industry for 2024. Going to move us on to digital health, and it's a topic I haven't seen heard in a lot of M&A venues, but obviously there's been some casualties over when we had the big run up in HCIT, but we've had some successes as well. Explorer Surgical being one of those, Jennifer, and maybe just share with the audience what were some of the keys that really drove that to being a successful outcome. What did you focus on? What was the had to be true criteria for you to be successful?
Yeah, so for us at Explorer, we started selling our product to hospitals, and we were able to do that successfully. I mean, it was painful, but we got these customers on board.
Yeah.
What we saw after we had, our first 10 or 12 hospitals on board was that the medtech community was actually a better customer for us at the time. So we made a pivot to that. When we made that pivot, we were consciously going into a customer that had better unit economics, but it was a smaller overall market. So the total addressable market selling to med device companies was smaller than hospitals. And we said, we're going to go sell to med device companies now with software as a service and go into the hospital market later. I think what happened was people got very excited about software in 2020 and 2021.
Yeah.
So I had investors that wanted to put in 50, 75, $100 million into the business. And it took a lot of financial discipline to say, what's the size of my market now? How much money do I actually need? I knew that I could get to break even with less than 10. And we declined those offers. And we decided instead to exit the business when we started getting acquisition offers in. So I think, you want to be very optimistic as an entrepreneur, but you also want to be a realist, and you want to really understand what's the size of your market, what do the unit economics look like, how much capital do I need, and what kind of a return can you generate? And I think there was a misbalance of a lot of that when you started looking at what was the true total addressable market for some of these products.
Yeah. And, you bring up an interesting point about, getting the hospitals on board, because I think one of the things I hear from medtech, executives is that hospitals now and in the future are going to want to deal with fewer companies, especially when it comes to IT and the plumbing. So maybe tell us a little bit how you fought that battle and won.
Yeah, I mean, I think hospitals want to do everything they can through their EMR, right? And so if you want to bring a new technology into a hospital, you are always going to fight a big battle if you're not part of that EMR. And it's been an exciting time. I mean, when I started, the company in 2013, and I told people that I wanted to put iPads into operating rooms, they looked at me like I was completely insane, right? Like, how are you going to do that? How could that be sterile, right? And then by the end, you've got an Android app, you've got a Windows app, you got all these different things. But what you learn is that the EMR is really taking that priority. So if you're not part of the EMR, there's going to be a long wait. It's going to be a battle. But you're also seeing the EMRs now get a lot more creative with having some of their own ecosystems. Yeah, so I think it's what MedTech has the advantage of is you're already in the hospital, right? You're working through them with software. You've got physical people in the hospital. And so I think there's a lot of inertia in healthcare for a good reason. But if you want to bring in a new technology, you have to really fit yourself into an existing workflow, whether that's people, process, or technology that's already embedded in the way that patient care is done.
Yeah, I mean, everyone talks about improving hospital workflow, but I think the advice here would be don't interrupt it. You have
to fit in with it, right?
Exactly. Yep, for sure. And Greg, at Vensana, I think one of your mantras is, or areas of focus is digital health and tech-enabled services. So maybe, provide a little bit of color. What does that mean, and where are you guys actually thinking about deploying capital in that vein?
Yeah, no, happy to. So, our mandate is kind of broadly defined as anything outside of drugs. So obviously inclusive of digital health and healthcare IT. Bread and butter for us, probably 70% what we're going to do is medical devices. But I think one of the things, at least how our thinking's evolved around some of these digital health opportunities is, they're actually not too dissimilar from a medical device from a, product lifecycle and commercialization standpoint. Often you have a subspecialty physician who's going to order it in some context of their workflow, either diagnosis or therapy delivery. Often it's going to require some sort of FDA regulation or feedback. You have to figure out a way to get paid for it. So either you got to fit under an existing reimbursement code or develop one. To do that, you need clinical data. So checking a lot of same boxes that a medical device has to check. And so on the one hand, I think it's a well-traveled path. On the other hand, to Jennifer's point, I think, how do you fit in the workflow and who's your stakeholder are still key questions. And a lot of these case studies are still being written. And so we're certainly bullish on the opportunity and for a lot of these technologies to improve patient care. It's just kind of figuring out, how do they fit alongside an existing, more traditional medical device-based therapy? And are they complementary or are they standalone products?
Yeah, no, it'll be an exciting time, and certainly a lot of room to go in the digital health as well. Chris, maybe just a little bit of Medtronic perspective, because I know at JP Morgan one of the whole slides of every CEO's presentation was on AI and what they're doing around it. Obviously, you guys have some pretty interesting plays already with digital surgery and GI Genius. Both, I believe, acquired technologies and then developed further within Medtronic. But, as you think about your M&A lens and, how you look at healthcare IT, where are the areas that are kind of top of mind for you guys?
Yeah, I mean, so we have about 5 product offerings that include AI today, right? And I see that that's going to continue to expand. We tend to look at it as it's part of that ecosystem that needs to be with the medical device implant or procedure, and really to help drive better outcomes. And so right now, right, we brought in Ken Washington to help us kind of rethink our AI kind of vision and direction. Not rethink, but continue to evolve it. But really, it's about how do we take this type of technology and apply it to various therapies that will actually drive even better outcomes than they're currently situating. So is it image guided? Is it AI? Is it help identifying, colorectal cancerous cells? Those types of things is where we see that the future is, and feel like that we'll continue to look at those types of technologies that complement our existing portfolio.
And I mean, just from a capital allocation perspective, I mean, how are you guys thinking about, how much you do organically with, Ken coming on board, and how much you're going to look to turbocharge, if you will, by looking outside the four walls?
Yeah, it's a great question, right? We have established a innovation center in India that has,
right,
I think, close to 1,000 engineers that are primarily data science engineers that is really looking at this from an internal place. That being said, right, this is all new for everybody that's in the medical device world, and it's all evolving. And so we're going to have to supplement our capabilities with external investment, partnerships, those types of things. And we've done some of those already, specific like GI Genius, right? We partnered with somebody externally to develop that. You're seeing those types of relationships, and I think we'll continue to do that.
And Bennett, maybe a question for you, because we're seeing a lot of positive traction on a number of spin-outs. Certainly with GE Healthcare out there now. I mean, I think they did maybe 5 or 6 deals over the last year, so very active. We'll have Solventum out in a matter of weeks. The Edwards business is going to be out there. I mean, what is this number of medtech companies that are publicly traded and have their own sources and uses of capital, and what does that do for the overall medtech M&A landscape?
Yeah, I think it's going to be fun.
Exactly. Yes.
I think. Look, you've had a number of great healthcare businesses within very large, diversified corporations, which for the first time now are unconstrained in some ways. As you think about strategy, as you think about focus. I think in each of these cases, there has been a ton of discipline from a strategy perspective. I think in terms of those management teams really spending time in where they want to focus, not only from a time and people perspective, but from a financial perspective. But I think it means that as they create their own footprint as standalone healthcare players in the ecosystem, they'll be enormously important. I think, as much as anything else, this is, at least from the, as I put my kind of earlier stage medtech hat on, it's not just the great kind of blue chip, long-standing healthcare companies like Medtronic, which is at the very top of that list, but it's also some of these newer entrants. And so keeping kind of an eye on the full field and where folks are spending time strategically, I think it's going to make for a very dynamic environment.
Certainly saw a lot of activity with the mid-cap medtech, certainly active on the M&A front. And it's always great to get a glass half full view as we're down the stretch. And speaking of that, maybe just a couple thoughts on, just conference sentiment compared to maybe last year. And Greg, I know we were chatting before the conference, but, I think last year you and I kind of compared notes really after the conference, and it was not a positive sentiment. It was one of beaten down and feeling sorry for people. And maybe just some of your perspectives this year, coming, so far.
Yeah, no, I mean, if you look back at 23, and I know we've talked about the data that shows that deal volume is down. I think that's true. Like with everything, it depends on how you cut the data. I think one of the other data points is that total funding dollars wasn't proportionally down as much, and so I think that part of what that probably reflects is a lot of venture firms are sort of doing insider-led rounds or trying to extend runway for their portfolio companies. And so, that takes some bandwidth away from the team of doing new deals. And so I think, there was a lot of that, I think, in the last 2 years. I think as we get on the other side of that, there is dry powder on the sidelines. I think you're going to be seeing people actively looking for new deals. I think I saw, a data point at a recent banker conference that said, 50% of the deals in 2023 in Medtech were insider-led. That's, pretty significant, I think, for what we traditionally see. And so I think as, we get into the 24, it definitely seems like there's a lot more positive sentiment.
Yeah, and Jennifer, maybe I'll let you have the last word. How are you feeling as, to a lot of the emerging companies that are in the audience? What are you feeling?
I think it's a great time to be building a new medtech company. Look, I think there's definitely some baggage from the last couple of years. There's no denying that. But I'm really excited to be starting a fresh company. I think looking, if you look over the cycles over time, you see these different cycles of great returns. And I personally think 2024 is going to be one of the best vintages of all time, right? You're coming out of, this crazy, unprecedented period in history.
Yeah.
And now, valuations are lower. You got to suck it up. It's a little bit harder right now to raise money. But if you can do it, there's a light at the end of the tunnel in 3, 4, or 5 years. And, the cycle is going to come back. So I'm really excited about leading an early stage company. I've got a lot of energy. I think it's a lot of fun. And I think for those who are deploying capital right now, this is a great time to have capital. You've got your pick of amazing companies. The terms are back in your favor, unlike what it was a couple of years ago. So I can't wait to see what this year brings.
It's a vintage 2024 wine for dinner tonight.
Absolutely.
There we go. All right. Well, hey, with that, we're in the red up here. So if everyone can, first of all, thank you for all the commentary. This is really insightful. Join me in thanking you. Thanks.